Welcome in. Today we are talking about behind the scenes of the loan process. This is the crash course on Home Buying 101, and we're going to look at mainly the difference between the loan officer, loan processor, and the underwriter, as well as what goes on with the appraisal process. So jumping right into it, the officer is the one who gives you the application and lets you know what paperwork you need to supply for the loan, which all of this is then sent to the processor. They receive your paperwork, they let you know if they need more, they order credit report and request verification from your employers and your bank. They also make sure that you can afford to take on this new mortgage on top of your existing debt plus monthly household expenses. And then they order the appraisal once that is all in order. Now, you won't work directly with the appraiser, but you will pay for their report, which is usually part of the estimate when you apply for the loan. And their job is to decide what the home is worth or its fair market value. They do this by comparing the home you want to buy with others in the area that have sold recently. And they also look at the condition of the house as it affects the market value. And so any special features that it would have get factored into this, like an extra garage door, high-end appliances, that kind of thing. They typically cost $300 to $700 depending on where you live, and they're going to be hired by the lender. Sorry, I know I'm not going in quite in order here, but they're hired by the lender. So again, you're not going to work directly with them. The lender hires them essentially to determine how much money they're willing to lend you. So they use the loan to value ratio to determine the highest loan amount that they're willing to provide for a specific house. And if that appraisal comes in less than the price you offered to pay, the lender may require a larger down payment. And if you can't make the larger down payment, you can either ask the seller to lower the sales price to meet the appraised value, or if you've included the financing contingency, which most offers include the financing contingency, then you can get out of the deal with your earnest money if the seller is not willing to lower the price. So the underwriter is going to be the final say in whether or not your loan gets approved. They're going to review all the facts related to the 4 C's of your loan. It was capital, capacity, collateral, and credit. So they're going to review all those facts. And then the underwriter is going to compare the information with the lender's loan policies and decide whether or not to recommend the loan. The final decision is usually made by a loan committee, but the underwriter's recommendation is critical in this decision. So while your application is getting approved, the loan officer is going to send you a commitment letter. And that letter states the amounts in terms of the loan. If it is approved, it'll be based on certain loan conditions or contingencies. So some loan conditions are standard for all loans, and other conditions may be specific to your loan, but standard loan conditions include like mortgage insurance, hazard, possibly flood insurance, etc. Washington, you can just have a home inspection. If that report comes in clear, you don't need to do further inspections, but if that inspection report, that initial home inspection report, reveals, for example, a crack in the foundation or potential termite damage, you're going to have to get a specific professional out there for another inspection before the lender is willing to loan the money. But that is how the behind the scenes work for the loan process. And I hope you found this valuable. If you did, please leave me a comment. If you didn't, please leave me a comment and tell me why. And if you have any questions at all, please email me. Check out the next video that I got coming up on managing the escrow process. All right, guys, we'll see you soon.